Hey guys, thank you for joining me. It's August 15th, and the markets are closed now. And for those that own a lot of stocks, they're very happy about that because it was all red all day. The Dow Jones finished down 225 points. The S&P was down 24 points to 1661, and the NASDAQ at 3606. It was down 63 points, or 1.72%. Small caps got beat up the most, down almost 2%, and we did see interest rates rise up to 2.75, and the volatility index jumped 13%. It's now just under 15. And you can see it started out really right from the get-go. We had some bad economic data come out this morning, and that was mostly before the bell. It started with the Philadelphia Fed Manufacturing Index. It dropped from 19.8 to 9.3. I know those numbers don't necessarily mean anything to you, but anything going from 19.8 to 9 doesn't sound good, huh? Economists were expecting 15. Empire State Manufacturing, another one, declined to 8.24. 10 was expected on that, so all these things are dropping. And then industrial production was supposed to have a 0.3% gain, and it was actually flat. The only thing better was jobless claims. It fell again, which is a number that continues to get better. But again, we've talked about the quality of jobs, not necessarily just the quantity. And then you add on top of that, Walmart missed their revenue estimates by $3 billion. You've got Cisco Systems is laying out 5% of their workforce, and they guided a little lower. And then you're seeing these big stalwarts starting to roll over a little bit. So all of that, and really the only thing that came out that was really good was the NAHB Home Builder Confidence Index. It actually went up. It was supposed to be at 57, I think, and it came out around 59. So it was better than expected, which got the home builders going. So we'll talk about that in a minute. But you can see right after the open here, this is a 5-minute picture of the Dow. We dropped very, very quickly. And then pretty much the rest of the day was really quiet. And there wasn't, even though it was down 225 points, it's 1.5%, you didn't see the panic. And therein lies the problem. I think a lot of the indicators that I watch, I went through tons of them today, and many of them are getting to the point where you would want to start picking some things to buy. But here's the thing, it's not necessarily where everything is so oversold. It's just you just start going in there and buying anything because anything's going to work. I don't think we're quite there yet, but I would say we're 80% of the way there. We still have some room to fall, but one thing that the markets did, the reason I think they fell and kind of paused at these levels is because we're right here at the 100-day moving average on the Dow Jones, and we'll show you the S&P in just a minute. But you can see last time the Dow Jones bottomed there as well. And so, obviously, one thing to be concerned about is a potential something forming this head and shoulders where, we did this, we come back down, we made a new top, we go down here, and then maybe we don't get up to the old high, and then we potentially go down lower. That's a formation we could be seeing setting up here. Now, if we look at the S&P 500, it's a little bit different picture. First of all, this thing had been moving sideways, very quiet. We had talked about how these bands were in a very tight range and it was going to break out one way or the other, and boy did it. It broke out to the downside pretty hard. But again, it bounced off its 50-day moving average. And I want to show you, if you look back, and the 50-day moving average is this blue line. If you look back for most of this year, where has the stock market bottomed out? 50-day moving average, 50-day moving average, 50, 50, and now we're at the 50. The only time it broke below it was this correction right in here, which was in June, and that was about a 6.5% drop. So big if, you think that this is going to be a run-of-the-mill correction just like last time, then we're getting into the zone that it's either going to bottom here, and that was it, or we're going to go down to perhaps this level, and come down and bounce off of there. But we're getting close to that level if this is a run-of-the-mill correction. And I actually went in today and covered our only short position. We had not a big short position on the S&P, but I'd been keeping that for probably 2 weeks, I would say. Right when we got up here and it started to look like we were going to roll over a bit, somewhere in this range, is when we put on a short position. And the market went sideways. It broke out, had one of these what we call fake out breakouts where it only lasted a day, came back in, but essentially was moving sideways, so we just held it. And then now that we are on this 50-day moving average, and it's likely to bounce here, but we probably have a little bit more further downside to go, we went ahead and covered that position. And so we're looking to actually use those proceeds to buy a dip. And what we would like to see, preferably, is kind of what we saw back here in late June, which was you had a big downdraft, you had another downdraft, and then you had this kind of intraday reversal. So, this is really only the second day. We had a 100-point down day yesterday, 225 today. It sure would be nice to get a big downdraft tomorrow and then perhaps some type of reversal off of that. That would make me a lot more bullish, to be honest with you. And I think that we are setting up for that. But a lot of indicators are mixed right now, but they're getting to oversold levels, but they're not quite there, but they're real close. So again, the caveat would be if this is turning into something bigger. And at this point, I don't think it's going to be. It was real interesting, though, to watch interest rates because we got that data this morning, and you would think, okay, well, we should see interest rates going lower today, right? Stocks are going down. The economy is still very susceptible to any type of shock. We've got a lot of geopolitical risk going on with Egypt and everything. So certainly we should have interest rates going down today. But it didn't. Interest rates actually went up today. And not only did they go up, they broke out of this recent trading range they've been in. Remember that we had been talking about that this thing was moving sideways. So we went up and then we started just moving sideways and we were just kind of locked in here. And today we actually broke out to the upside. Now, you see that right here. But here's the thing, that interest rates peaked, and then it's almost as if they got to a level where the stock market really got scared, and people said, you know what, maybe we should buy some of those treasuries. They're actually yielding a little more than they were a few months ago. They're actually almost 3% now. So why don't I go buy some of those right now? And so you saw interest rates come down for most of the day. They still finished up on the day, but not as bad as they were this morning. They were really getting hit hard. So perhaps, what if this looks just like the stock market a few weeks ago, where what if we have a similar fake out breakout, right? Didn't we just do this with the stock market where we went up and I told you about that, and then it came back in and went sideways a little longer and then it came back down? What if interest rates do that? There's going to be a tipping point where interest rates start to go down because people are scared of the stock market. Right now they're simply taking profits on the stock market and they're moving that money to cash, and they're moving away from the bond market. But it does beg the question, isn't it interesting that the Fed has come out and essentially told you we are going to start this process of tapering this year, and we're going to, it's data dependent, but we're probably going to start it this year, and we'd like to conclude it next year. So that's the game plan. Now all of a sudden, various pieces of economic data are coming out, and you're going, wait a second, the Fed's going to take away the punch bowl at the very same time that the economy is slowing down? That's not good, and so down goes the stock market. And that's what we're seeing right now, I think, is people are really struggling with, okay, if they are going to taper, should they be right now? The economy was getting marginally better, and they were going full blast. Now they say they're going to take it away, and the economy's starting to slow down. It doesn't make a lot of sense. So I think bond market's confused, and the stock market's a little confused right now. But ultimately, when you stand back, it still appears that the stock market is the only game in town. That doesn't mean, again, today's the bottom, but we are getting stretched to the downside. Now, this is home builders. Home builders, ITB is the ETF, and they had been on just a complete run. Unbelievable. But when you kind of zoom out a little bit, you will notice what's going on here. Right? That's the picture I see, which is more of a rounding. If you take a look at some of these moving averages, they're all crossing each other. And this is a direct correlation. When did interest rates, actually peak? Or bottom? It was around May 1st, right? Well, look what happened. Stocks, the home construction stocks went up a little bit further, and they've been going straight down ever since. And we've started to see in the last few months that some of the housing data started to come in a little weaker, as if it is affecting the housing market. And so that's why when this number came out this morning, this NAHB confidence number, it actually was better than expected. That gave people a glimmer of hope that, hey, maybe the housing recovery isn't dead just yet. And so you saw a massive short covering rally. This is the intraday picture. And what you see here is that, and this is yesterday, so we closed right here. It opens down here, which what I think was about 3% or so, and then it just went straight up the rest of the day, and it actually finished up 2%, 2.5% on the day. So we saw like a 5% intraday reversal, and that was, that's encouraging because it was kind of interesting. There was some various construction stocks today. If you look at something like, and I don't own this particular company, but Caterpillar actually finished positive on the day. Some infrastructure stocks that I follow and own were up on the day pretty strongly. You had some mining stocks up on the day, home construction. So despite interest rates going up, you actually saw some of these, let's call them inflationary type things, actually work. They actually worked. They actually went up on the day. That was really interesting to watch. And by the way, if you haven't seen it, this is what Caterpillar looks like over the last few months. In 2013, it was a $100 stock earlier in the year. It's down about 15%. And by the way, when we start talking about some of these big companies, look at IBM, $185. It was $215 at its peak. So those things are going down. Then you start punching out Walmart, and you can see it's touching its 200-day moving average, which might be an interesting play if it can stabilize at these levels and people do perceive the slowdown in the economy. And then we also take a look at Exxon, which had that long losing streak, and it's really only had one up day. I don't know. This goes all the way back to, it's had one up day going all the way back to July 24th. It's only had one up day in all of August and late July. It's been pretty much straight down. So Exxon is getting hammered, and again, you're seeing this fake out breakout that we talk about where technically it looks like that was this was it 3 days in a row, and then it comes back into it and goes straight down. So be careful on some of those because that can happen pretty easily, and the stock market just exhibited that as well. Let's go on to gold. What you're seeing with gold is pretty impressive, actually, because not only did you see gold riding this down, and we talked about the 50-day moving average had been kind of your area to watch. Remember, we talked about that in prior podcasts. We had blog articles about it. But you see the ultimate peak there. Then you see the 50-day moving averages bumping up against it several times, and then it couldn't even get up to it here. Finally gets back up to it after some strength, but just couldn't get above it. Finally breaks above it. You have these moving averages crossing, and now we're in the new zone, which is we're in this box. Okay, so now we're in this box. So you have to look at this and say, well, it seems logical that the next place we're going to go is we're going to spend some time in this box, right? This is where we're going to spend some time between 130 and 140. And that's highly possible. I don't believe we will go back down to these lower levels, but it's quite possible. But maybe you're seeing a shift in some inflation expectations. Remember, you saw the home builders reverse today. You've been seeing metals and mining stocks today. If you look at the metals here, look at the miners. They had a 6% move today. So they're actually moving up much faster than gold itself. They've been severely underperforming. They're moving up. So you've got these things moving up. Energy stocks are holding up in this environment. So it's a real interesting shift going on. And I'm starting to see some pretty smart people talk about inflation. And remember, the whole reason gold has been doing this is because we haven't had any inflation to speak of when you look across the board. Yes, I know we have medical inflation and we have inflation at the grocery store in certain areas, but there's a lot of deflation going on, or disinflation, we should call it. And perhaps that's changing. Is gold telling us something? It's too early to tell, but it's something, I still own GLD. It's one of my long positions, and I don't see any reason to sell it. A lot of things have started to bottom that weren't working. Apple, this was a classic turnaround. We had showed you this when Apple was going down and then it started to move sideways. We pointed out the fact that this is what a basing stock looks like, where it just moves sideways. All the moving averages are starting to go sideways, and it spends a lot of time down here, fools a lot of people, and then, of course, you got the benefit of having the icon comments on Twitter saying he owns it, and now it's broken above some of these moving averages. But I do think it's perhaps a time that Apple should pause, and it may spend some time in this zone here for a while, and then again maybe this moving average just starts to turn up, and then it can go higher eventually. But it's had a big run, and the news is out. And remember, when Carl Icahn says he owns something, it's usually because he's getting involved in a company that A, he thinks is cheap, or B, he sees a problem that he thinks he can fix. And so he's involved in Apple, talking to the CEO, telling him, you need to do this with yours. This is the best avenue for you. You need to purchase back stock, and giving him advice. So is that something the CEO really wants? I don't know. But as somebody pointed out on Twitter, do you think Steve Jobs would have answered the phone? I don't know. Probably not. But Tim Cook answered the phone. And I think he's wanting anybody on his side at this point when the stock has dropped from 700 to 3 something. But now it's back to $500 and hasn't closed above it, but it's back up at that range. But, it probably will spend some time in here, but it certainly looks better than here. And patience has been rewarded. If you were owning it down in here, it's been rewarded. But we've seen some big moves out of Apple. We've seen some big moves out of the gold mining stocks. The home builders were really big today. So, we're seeing these big moves, and it is interesting to watch this because you are seeing some of the leaders fall. In fact, even something like a Priceline. Remember, we pointed out Priceline last week saying, hey, this thing's getting pretty tight here. They're coming out with earnings. It's breaking out, and we were kind of leery to buy it before earnings. Turned out to be buying it before earnings would have been a great move because it did pop. Never quite reached $1,000, but look what's happened since. All of that has been given back. All the earnings pop. And so that doesn't mean the trade's over at all, but it's pointing out that, unless you're trading this really quickly, like within days, the gains are going away. And so what'll probably happen with Priceline is I'm not saying that people should get out of it if you own it, but you're getting this where it came back and then it's coming back down to this, moving average, perhaps even maybe the 50 somewhere around $900, and then heads back up. But you're seeing all those gains be given up from some of those things, and then some of the leaders are starting to roll over a bit. So it's an interesting market what's happening right now, and we do have some of this, turmoil going on overseas. But overall, I still believe at the end of the day, there's always something for the market to worry about, and I see a lot of complacency on the part of investors. We can see that in the VIX, but I don't think it's complacency that is over complacent. In other words, I don't believe people are saying, hey, get me out of everything, just throw me in the stock market. People are still leery of the stock market. They're still hesitant, and that's good. That's what you need for it to continue to go higher. But we do have had these spikes, and they've been buying opportunities every time. And you can see this green line's a moving average, and you can see it starting to turn up. And so we're starting to get a little fear building. You have a couple more days of this spike in here, and again, until proven otherwise, why wouldn't it gets up here? Why isn't that your time to go buy stocks? And it probably will be this time again. So the only thing that we do have that's happened is we do have some deterioration in some of these advanced decline lines and things of that nature, who's participating in this market. But we also have these Hindenburg omens, right? You've been hearing about that the last few days, and it's a confluence of a bunch of different technical indicators happening at the same time, and they say, well, it preceded the last big crashes, but it also happened a lot of times that crashes never came, right? It predicted the last 5 out of 3 crashes, okay? And so while we need to monitor it, the data doesn't suggest that those are very relevant. And so I think it's actually something that can affect markets in the short term, but actually in the next 6 to 9 months, it wouldn't have affected the markets. So caution still warranted here, but I did cover the short position. The next thing I would do is use that cash that I've been holding back to buy this dip. And again, remember, in this market, you have not had many opportunities to buy any dips. So, you may want to buy it down here at 1550, but you may not get your chance. Remember, what's happening with these moving averages, they keep moving up. So it's as if, your buy points are getting a little higher each time. So perhaps, the buy point is somewhere between 1660 and we'll call it 1625. That may be the time to start putting some money to work if you want to get invested. All right, have a great evening and keep the questions coming. Thanks. We'll talk to you soon.